$20 million turning into tens of billions. I mean, it sounds like the stuff of legends, right?
It really does.
But it's a very real story. And it centers on Warren Buffett and American Express.
Yeah.
How did this happen? What are the crucial insights for us? Let's unpack this remarkable journey.
Well, it's not just about the staggering financial growth, although that's obviously impressive. It's really a powerful demonstration of long-term value investing.
Right.
And the ability to capitalize when even really strong businesses face, let's call them temporary challenges.
Yeah.
We'll be looking at specific historical turning points and the key financial details behind it all.
Okay, so today we're diving into two significant crises that hit American Express. First, we'll go back to the 1960s and this, well, strange salad oil scandal.
Sounds bizarre, doesn't it?
It does. Then we'll jump forward to the early 1990s, which was a period of intense competition and internal shifts for Amex.
And in both cases, Buffett saw something that, well, the market seemed to overlook. And for you, our learner, our goal here is to really extract the essential knowledge, those aha moments, from this whole investment story.
Yeah.
We want to give you a clear understanding of Buffett's core principles, the immense potential of patient capital, without getting bogged down in unnecessary detail.
Okay, let's get into that first crisis then. The great salad oil scandal of the early 1960s. It really does sound almost unbelievable.
It does. We're talking about a company called Allied Crude Vegetable Oil and some, let's say, highly questionable warehouse receipts.
And these were linked to Amex's own storage subsidiary.
That's the connection. What's fascinating here is just the sheer scale of the alleged deception. Allied Crude claimed it had something like $150 million worth of salad oil. But the actual amount, closer to maybe $6 million.
So a huge difference.
Enormous. And this massive discrepancy, these sort of phantom assets, they were used as collateral for substantial loans.
Okay, so when the fraud finally came to light, the impact on American Express must have been immediate.
Oh, absolutely severe. Their stock price just plummeted. It dropped by over 50%, from around $60 down to about $35 in early 1964.
And the direct financial hit.
Also significant, close to $58 million. That was a lot of money back then for Amex.
So this was a really pivotal moment for them.
It truly was. And their CEO at the time, Howard Clark, made a really critical decision.
Which was?
Well, despite the huge financial hit, he chose to honor all those disputed warehouse receipts, basically covering the fraudulent claims.
Why would he do that? That's a massive cost.
His reasoning was clear, and I think quite insightful. He believed the foundation of American Express's entire business was trust.
Especially with traveler's checks back then.
Exactly. And that trust simply had to be preserved, pretty much regardless of the immediate cost.
It's interesting, though, you look at the economic backdrop then. The U.S. economy was actually doing okay, wasn't it?
Yeah, surprisingly well. GDP growth was around 4.4% in 53, then 5.8% in 64. Interest rates were relatively stable, too.
So this suggests the broader economy wasn't the main driver here. This was a very specific Amex crisis.
Precisely. That stable economic environment probably provided a bit of a cushion,
Yeah.
It allowed Amex's fundamental business, the core operations, to stay relatively sound despite the scandal hitting the subsidiary.
And this is where Buffett steps in.
This is where Warren Buffett made his move. During this period of, intense uncertainty, his investment partnership put about $20 million into American Express,
Okay.
acquiring around a 5% stake, which, if you do the math, valued the whole company at roughly $150 million at that point.
So what was the key insight? What made him invest when things looked, frankly, pretty bleak?
Well, Buffett's key insight seems to have been recognizing that the salad oil scandal, while obviously serious, was really an issue within a subsidiary.
Right, contained.
Exactly. It wasn't a fundamental flaw in Amex's core business.
Yeah.
The traveler's checks, the growing credit card side. He even reportedly went out and observed people still using their Amex cards.
It's a little bit of anecdotal evidence there.
Yeah, sort of real-world validation that the brand still held power despite the headlines.
And it seems that insight paid off quite well for him.
Paid off handsomely, you could say. By 1968, just a few years later, Buffett had sold his position. He bought in at a split-adjusted price of about 94 cents and sold around $5 per share.
That's a fantastic return on that initial $20 million.
Absolutely. And this early success really validated his investment thesis. The salad oil scandal had created this temporary but pretty substantial gap between MX's true underlying value and its market price.
Fear drove it down.
Exactly. Fear and uncertainty had hammered the stock, creating a classic value investing opportunity for someone willing to look past the immediate noise.
Okay, let's fast forward then a couple of decades later. American Express faced another really challenging period in the early 1990s.
Right.
This time, though, it wasn't just one bizarre event. It sounds like it was more of a combination of different pressures. What were the main factors then?
Yeah, the early 90s presented a much broader, more systemic set of challenges for Amex. The whole competitive landscape had shifted dramatically.
How so?
Well, you had the rise of Visa and MasterCard. They were aggressively gaining market share, often with lower or even no annual fees, which was a direct hit to Amex's model.
And new cards were coming out too, right?
Yeah, things like the AT&T Universal Card put even more pressure on Amex's established fee structure.
Yeah.
And the result? They lost over 2 million cardholders during this period.
Wow, 2 million. That's a considerable number. And it wasn't just competition for cardholders, was it? I seem to remember something about merchants. The Boston Fee Party.
Yes, the Boston Fee Party in 1991. It's a very public, very pointed demonstration of dissatisfaction from merchants.
About the fees Amex charged them.
Exactly. Amex historically charged higher transaction fees than Visa or MasterCard. So retailers in the Boston area basically organized a protest, refusing to accept Amex cards for a period.
That must have gotten their attention.
It certainly highlighted a growing tension, and ultimately, it compelled American Express to reduce its average merchant fee, which had been as high as, I think, 3.22% back in 1990.
Okay, so pressure from competitors, pressure from merchants. And if that wasn't enough, there was also the Optima card situation. What went wrong there?
Right, the Optima card. This was Amex's first real dive into revolving credit, unlike their traditional charge card.
And it didn't go smoothly.
Unfortunately, no. It resulted in pretty significant losses. It seems they had inadequate credit risk management initially. Combine that with a weakening economy around that time, maybe some more lenient lending standards to gain share.
Recipe for defaults.
Exactly. In just the third and fourth quarters of 1991 alone, Amex anticipated writing off around $365 million due to Optima losses.
Ouch.
Yeah, and that also led to about 1,700 job cuts.
It really highlights the difficulty, of entering a new market segment without maybe the right expertise and controls in place from the start. It really sounds like Amex was just getting hit from multiple sides at once. Weren't there also some strategic issues lingering from before under the previous CEO?
Absolutely. The strategy under James Robinson III, this attempt to build a massive financial supermarket, it kind of led to a lack of focus, maybe some operational inefficiencies.
That's him.
Sort of. The company had become overextended, and they were subsequently forced to sell off valuable assets, like the Shearson Lehman Brothers brokerage.
Right, I remember that.
And there was also this growing perception, both externally and maybe internally too, that the company culture had become a bit elitist and arrogant.
Which could hinder adapting to the market.
Exactly. Making it harder to react quickly to all these changing market dynamics.
But then things started to change with new leadership. Harvey Golub took over as CEO in 1993. What did he do?
Golub's arrival really marked a critical turning point. His primary focus was, first and foremost, aggressive cost reduction. He was aiming for savings of about $1.6 to $2 billion, which was substantial, coming from a $13.4 billion cost base.
That's a big cut.
Huge. And he also streamlined the organization, basically refocusing Amex on its core strengths. The charge card, travel services, and their financial services arm. Getting back to basics, essentially.
And did these efforts start to show up in their financial results fairly quickly?
Well, it took some time. Naturally. 1991 was obviously heavily impacted by those Optima losses we talked about. But by 1994, you started seeing the turnaround.
Yeah.
Amex reported net revenues of $14.3 billion and a net income of $1.4 billion. And importantly, their loan loss reserves were reduced, which indicated better credit quality in the core businesses.
In 1995.
Things improved further. Net revenues hit $15.8 billion, net income $1.6 billion. Although it's worth noting, global loan loss reserves did tick up slightly that year.
Why was that?
Mainly due to portfolio growth and maybe slightly higher loss rates in some international markets, but the overall trend was positive.
Okay, and what was the general economic environment like during this whole turnaround period, say 1990 to 1995?
It was a bit mixed. The early 90s saw a mild recession in the U.S., but then the economy staged a pretty strong recovery starting around 1992.
So growth picked up.
Yeah, GDP growth rebounded quite significantly. Interest rates also fluctuated quite a bit. The prime rate started high, around 10%, then dropped down to 6% before climbing back up towards the 8.59% range by 95.
So those shifts would have definitely influenced Amex's borrowing costs and lending margin.
Undoubtedly.
Yeah.
A complex backdrop for their turnaround efforts.
So against this backdrop, a company facing really significant challenges, initiating a recovery, shifting economy, Warren Buffett makes another, much larger investment,
Right.
committing $1.3 billion to American Express between 1991 and 1995. That's a huge step up from the initial $20 million back in the 60s.
It absolutely is a much bigger bet. And his rationale this time was, well, arguably more complex.
How's-
He acknowledged the numerous difficulties Amex was clearly facing, but his confidence seemed to stem from the enduring strength of the American Express brand itself.
That moat again.
Exactly. He described it as being synonymous worldwide with financial integrity and a medium of exchange. He still saw that core power.
And the network.
Yes, he recognized the power of their established network, that closed loop. And crucially, he seemed to have confidence in the potential of the new management team under Harvey Golub.
So faith in the turnaround plan.
Faith that Golub could address the issues and, importantly, preserve the, quote, specialness of the card. Buffett viewed these significant problems as temporary for what he still saw as a fundamentally strong franchise.
It's really interesting how his investment thesis kind of evolved between the two periods, isn't it?
It really is.
The first seemed focused on, like you said, a contained crisis, a subsidiary issue. The second addressed much more widespread systemic problems.
Exactly. The challenges of the 1990s were definitely more systemic. They came from major market shifts, internal strategic missteps.
Yeah.
It required a comprehensive overhaul, not just fixing one part.
So his bet in the 90s was really on the core business resilience and leadership.
Precisely. It was a bet on the core franchise's enduring strength, plus the new leadership's ability to execute a successful turnaround. You had this combination of internal problems and external pressures, creating intense market pessimism.
Which created the opportunity.
Right, the value investing opportunity. And Golub's appointment, in Buffett's analysis, provided that credible path to recovery he needed to see to make such a large commitment.
Okay, let's look at the financial outcomes then, specifically from the second major investment. We know the stock price was volatile during both crises. Can you just remind us of the key price points again?
Sure. So back in the salad oil scandal, the stock fell from around $60 to a low of $35. Buffett got in, split adjusted, around 94 cents, and sold near $5. Now, for the 1990s period, in August 1991, the stock price was down to approximately $6.50, again on a split-adjusted basis.
And Berkshire put in $1.3 billion.
Right, between 91 and 95 for an estimated 151.61 million shares. If you calculate that out, the average purchase price works out to be roughly $8.57 per share.
And where is American Express stock trading recently, let's say around mid-May 2025?
As of May 13, 2025, the closing price was $302.24 per share.
Wow. So that journey from those crisis lows around $6.50 or even $35 back in the 60s up to over $300.
It really illustrates how the market can sometimes, well, dramatically overreact to short-term difficulties, even in fundamentally sound companies.
Creating those entry points.
Exactly, for patient investors willing to look longer term.
Now, for the really eye-popping part, quantifying Berkshire's returns on that $1.3 billion investment, it's grown just exponentially, hasn't it?
Exponentially is a good word for it. Based on that share count, 151.61 million shares, and the recent stock price of $302.24. Berkshire's stake is now valued at around $45.82 billion.
$45 billion from $1.3 billion.
Roughly, yes. That represents a capital gain of approximately $44.52 billion, which is about 35 times their initial investment, just on the share price appreciation.
And that doesn't even count the dividends they've been collecting all these years, does it?
Correct. And the dividend income has been really significant, and it's been growing consistently.
How much are we talking?
Well, back in 1995, the annual dividend payout to Berkshire was around $41 million. Fast forward to 2024, that annual figure was about $409.3 million.
Just in 1 year.
Just in 2024. And it's projected to be even higher, around $497.2 million in 2025, based on the current quarterly rate.
So over 3 decades they've received.
Billions of dollars in cumulative dividends from American Express, which massively enhances their total overall return.
But there's another fascinating angle here. Berkshire's actual ownership percentage of Amex has gone up over time, right? But they haven't actually been buying more shares. How does that work?
Ah, yes. This is a really powerful illustration of the impact of share repurchases or buybacks.
Oh.
American Express has been actively buying back its own stock in the open market over the years. When a company does that, it reduces the total number of its shares outstanding.
Right.
So since Berkshire just held on to its fixed number of shares, that 151.61 million, their percentage ownership of the entire company passively increased. It went from around 10% initially to now about 21.6%.
So they own more of the pie without putting in more money.
Exactly. It's sometimes called a silent increase in ownership. Their claim on Amex's future earnings and assets goes larger simply because the denominator, the total share count, got smaller.
That's a huge benefit for long-term holders.
It's a massive wealth-generating effect, especially for long-term concentrated investors like Berkshire, when companies strategically and effectively allocate capital to buy back their own shares.
These financial details really drive home the incredible long-term value creation in this specific story. Now, I want to dig a bit deeper into the specific risks Amex was facing during those two critical investment periods for Buffett. Let's start back in the 1960s. Beyond the immediate $58 million loss from the salad oil fraud, what were the really major concerns then?
Well, in the 1960s, the risks were potentially catastrophic, existential almost.
Really?
Yes. Those initial estimates of potential liabilities, around $144 million, were huge compared to Amex's capital base at the time, over 3 times their capital, even though the direct loss ended up being closer to $58 million.
But what was the truly terrifying part for investors?
Probably the most significant risk stemmed from Amex's structure back then. They operated as a joint stock association.
And what did that mean?
Crucially, it meant shareholders could potentially face unlimited liability if the company's debts ever exceeded its assets.
Unlimited personal liability.
Yes. This created absolute widespread fear, especially among institutional investors. Suddenly, they faced this unforeseen personal financial risk far beyond their initial investment. If Amex had somehow gone bankrupt with massive debts,
And investors could lose more than just their shares. They could be on the hook personally.
that was the fear. It was a terrifying prospect that absolutely fueled the market's panic and that huge stock price drop.
Wow. Okay, so that structure was a massive risk factor.
Huge.
Yeah.
And couple that with the potential damage to their reputation, particularly for the traveler's checks business, which, as you said, was built entirely on trust. The scandal had the potential to just completely undermine the company's foundation.
When you look at their size then, 1963 revenue was $100 million, net income $11.2 million.
Right, so a $58 million direct loss was a massive, massive blow. The unlimited liability structure just amplified the perceived risk way beyond the actual financial hit.
Okay, so that covers the 60s risks. Now, what about the early 1990s when Buffett made that second, much larger investment? It sounds like a very different set of challenges.
Very different, yes. The 1990s presented a much more diverse, kind of multifaceted set of risks.
Like the competition we talked about.
Exactly. That increased competition from bank-issued cards, new entrants, that was a huge strategic threat, leading directly to losing market share and millions of cardholders.
And the merchants.
The strained relationships with merchants due to those higher fees, culminating in the Boston Fee Party, really threatened the core viability of their acceptance network. If merchants stop taking the card, the whole model suffers.
Then the operational failures.
Yes, the massive losses from the Optima card starkly revealed significant weaknesses in their credit risk management processes as they entered that new territory.
And strategically.
The failed financial supermarket strategy under the previous leadership had created this perception of inefficiency, a lack of clear direction. And then there was that cultural aspect we mentioned, the perception of being maybe arrogant or slow to adapt.
So it really wasn't a single isolated event like the salad oil scandal. It was much more like a confluence of competitive pressures, internal operational issues, and strategic missteps.
Precisely. While the Optima losses in '91 were a huge financial strain, the need for that major strategic overhaul, shown by the restructuring GoLip initiated in '93, indicated deeper, more systemic problems needed fixing.
But the numbers started improving by '94 and '95.
Yes, the improving profit and loan loss reserve figures suggested a recovery was definitely underway. But the fundamental need for better credit risk management across the board and adapting to that tougher competitive landscape remained.
And the market saw this.
The market pessimism was palpable. You heard sentiment like the American Express card had become tarnished. And as that widespread negativity, that disconnect between the temporary problems and the underlying brand strength, that created the valuation opportunity Buffett seized.
Okay, These two periods of crisis and Buffett's decisions to invest heavily during them offer some really compelling insights into his core investment logic. Let's unpack those. First, this focus on a sustainable brand and business model, the whole idea of an economic moat. How did that apply so strongly to American Express in his view?
Well, Buffett clearly saw the American Express brand itself as an incredibly valuable, almost timeless asset. He called it synonymous worldwide with financial integrity.
Right.
He understood that this deep-seated reputation, combined with strong customer loyalty, particularly among affluent customers, created a really significant barrier for competitors. It's hard to just replicate that level of trust and prestige overnight.
And the closed-loop network was part of that moat, too.
Absolutely. That network, where Amex is both the issuer and the processor, gives them unique advantages. They get incredibly valuable data on spending patterns. They have more control over the whole customer experience. And crucially, they capture a larger slice of the economic pie from each transaction compared to Visa or MasterCard's open-loop model.
Plus, the focus on more affluent customers probably helped with risk.
Generally, yes. Lower default rates historically, and it also provided a very desirable high-spending customer base for merchants to target, even if the fees were higher. The key insight here wasn't just that Amex had a good brand, but that its brand represented trust and exclusivity in a way others struggled to match. That's a powerful psychological moat.
And he explicitly talked about looking for these kinds of businesses, didn't he, in his shareholder letters?
He did. Famously, in his 1994 letter, he stated that principle. We try to buy businesses with decent to wonderful economics, run by honest and able people at a sensible price.
And he saw Amex fitting that bill, even in the troubled 90s.
It seems so. Despite all those temporary challenges, his analysis clearly indicated that the underlying economics, the franchise value, the brand were still wonderful. It really underscores his ability to look beyond the short-term noise and assess that fundamental economic moat.
Okay, the second key element then seems to be his confidence in leadership, especially during that 1990s turnaround. How critical do you think Harvey Golub's arrival was in Buffett reinforcing his investment?
Oh, I think Golub's appointment as CEO in '93 was likely a crucial factor, maybe the crucial factor for the large '90s investment.
Why is that?
Because Golub took decisive action. The restructuring, the huge cost cuts, the refocusing on core businesses, it provided a credible, tangible roadmap for recovery that Buffett could see and likely believe in.
Aligning with his honest and able people criteria.
Exactly. Buffett consistently emphasizes wanting honest and able people running the businesses he invests in. And his comment later, I think it was the 1995 Berkshire meeting, I think the management of American Express understands how to keep the card special, really supports this.
And Berkshire even agreed to support Golub long-term, didn't they?
Yes, they actually agreed to vote their shares in favor of Golub and his successors as CEOs. That demonstrates a really deep long-term faith in the leadership's ability to navigate the challenges and restore the company's fortunes.
It highlights that even a great brand needs good management.
Absolutely. A great brand can definitely be damaged by poor management. Golub directly tackled the strategic errors of the early 90s. Buffett investing heavily at that juncture really signaled his view that Golub was that able manager needed to turn things around, and history proved him right.
Okay, finally, it seems like a core pillar of Buffett's entire strategy involves capitalizing on the temporary misfortunes of otherwise great companies. He seems to thrive when others are panicking.
That's absolutely central to his approach. That 1994 shareholder letter quote you mentioned earlier is so relevant. We've made the most money when macroeconomic worries have peaked. Fear is the foe of the fattest, but the friend of the fundamentalist.
And both Amex crises fit that mold perfectly.
Perfectly. Both the salad oil scandal and the difficulties of the early 90s generated immense fear and uncertainty around American Express. Charlie Munger apparently recalled that during the salad oil scandal, Warren figured out it was minor in the grand scheme of the core business.
And Buffett himself has said something similar.
Yes, he's quoted as saying, "I like buying businesses when they've got a temporary problem. We've made the most of our money when we've had temporary troubles."
So the sensible price comes from the fear.
Precisely. His principle of buying at a sensible price is directly tied to market sentiment. Widespread fear often leads to fundamentally sound assets being priced irrationally, well below their intrinsic value. That creates the sensible price opportunity that Buffett's value strategy requires. This ability, this discipline, to act countercyclically, to be greedy when others are fearful, is a key differentiator of his long-term success.
So bringing this all together, what are the most important lessons, do you think, for the individual investor that we can really take away from this deep dive into Berkshire's amazing investment in American Express?
Well, one of the absolute most crucial lessons is just the sheer power of long-term value investing.
Okay.
Patience is key. Berkshire has held a significant stake in Amex for nearly 30 years now. It demonstrates the immense potential of compound returns and, importantly, allowing your investment thesis the time it needs to actually unfold, not getting shaken out by short-term market noise.
That Buffett quote about weeds and flowers comes to mind.
Exactly. Weeds wither, flowers bloom. He specifically cited Amex with that. It highlights the importance of patience, something often overlooked, I think, by many individual investors rushing for quick gains. Real, significant wealth creation often takes decades.
And lesson number 2 has to be the importance of identifying those sustainable competitive advantages, right? Those economic moats.
Absolutely fundamental. Amex clearly possesses several strong moats. That powerful global brand we discussed, its unique closed-loop network, its affluent customer base, it reminds me of Charlie Munger's wisdom. You want advantages that can work for you for a long, long time, almost protecting the business.
But moats aren't permanent, are they?
That's a critical point the Amex story illustrates. Moats aren't static. The challenges of the 90s showed how competition could potentially erode a moat. But subsequent actions by management refocusing, adapting, now attracting new generations like millennials and Gen Z, help strengthen and adapt those moats. So it's not just finding a moat, it's understanding that they require active management and adaptation over time.
Okay. Then there's the whole psychological side of investing, the critical need for patience, yes, but also adopting a contrarian mindset sometimes.
Definitely. Buffett's investments in Annex during those periods of really deep market pessimism perfectly exemplify his most famous quote: "Be fearful when others are greedy, and greedy when others are fearful."
Easier said than done, though.
Much easier said than done. It underscores the need for you as an individual investor to do your own thorough research, develop real conviction in your analysis, and, crucially, avoid just following the herd, the prevailing market sentiment.
Trust your homework.
Trust your homework. If your fundamental analysis is sound, you'll likely be proven right eventually over the long term. Emotional discipline, keeping fear and greed in check, is truly just as crucial as analytical skill for long-term success.
And finally, maybe a slightly more technical point, but the impact of share buybacks and dividend growth seems really important here for total return.
It really is, and often underestimated. Amex's consistent share repurchase programs significantly boosted Berkshire's ownership stake, as we discussed, without any extra investment from them. That's a huge lever.
And the dividends just kept rolling in and growing.
Right. That steadily increasing dividend provided a substantial and growing stream of cash flow back to Berkshire over decades. So the lesson for individual investors: look for companies with shareholder-friendly capital allocation policies. That means sustainable dividend growth and sensible share buyback programs. These actions can significantly enhance your long-term total returns beyond just the stock price going up.
So to kind of wrap this up, this deep dive into Berkshire Hathaway's investment in American Express, it's just such a compelling case study in long-term value investing, isn't it?
Absolutely.
We've seen how Buffett's core principles, identifying these resilient businesses with strong economic moats, placing trust in capable leadership, especially during turnarounds, and having the guts to capitalize on temporary crises, how all that has led to just extraordinary returns over the very long run.
And it really transcends just the huge financial gains. This story validates an entire investment philosophy, one that's deeply rooted in truly understanding the underlying businesses you own, recognizing those durable competitive advantages,
Yeah.
and crucially, possessing the conviction and the emotional fortitude to act when market sentiment gets irrational and deviates wildly from intrinsic value.
It really makes you think, doesn't it?
Yeah.
You start wondering what other companies out there today might seem troubled on the surface, but are actually fundamentally strong businesses facing temporary issues. Could they represent similar long-term opportunities?
That's the million-dollar question, isn't it? Or maybe the billion-dollar question in this case.
Yeah, maybe. It's certainly worth encouraging you, the listener, to explore Buffett's investment philosophy further and this whole concept of economic moats across different industries. See where you might find them.
Absolutely.
Well, thank you for joining us for this deep dive into a truly legendary investment.